All right. And I'm going to share screen. Sorry, we're a few minutes late. Those of you who've joined us, we usually give a minute or two to allow people to um, to get in the room and put their coffee in front of them and get their lunch if they're doing that. So just a couple of housekeeping things. Today's session is beyond investing in what you know, how to succeed in diversified venture investing. It's a topic that's been coming up quite a bit as people who are traditional investors in real estate and other forms of alternative assets are now looking at ventures and trying to get familiar with that because they're looking at the great returns. So a couple of things before that, we do have a disclaimer. This is for accredited investors only, and so we want to help the guests today abide by the various rules and regs that have been laid before us. We have the same things. We have our heretofores and notwithstandings. So we don't provide investment advice or endorsements due to the nature of our industry. We're a neutral third party. We're not an advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expertise is required, the services of a competent professional should be sought. And all information that we present on these webinars and podcasts are provided for educational purposes only. So we encourage you to consult with your attorneys, accountants, and financial advisors before entering any type of investment. Now, that's out of the way. As I said, venture investing is becoming of great interest to the alternative investment community and to the IRA and 401k investors. The primary attraction for us in getting into alts is greater control because we're investing in things that we know and we understand. So we have a lot of people that come to us from real estate and former real estate agents. We have people coming to us who are bankers and mortgage people. We have people who come directly from industries that they've retired from or left and understand those industries, but see opportunities for investment. But what about diversification? Once you've covered your bases about what you know, how do you broaden your portfolio? Well, we're going to talk about that today, and we're happy to have with us Scott Wolfrum, who's going to help us understand that. He's managing general partner of Elpis Opportunity Fund. He's the president of Wolfrum Capital Management Group and Wolfrum Company, LLC. He's a majority owner and managing GP of Elpis Capital, which is what we're going to talk about today. And he also finds time to run a chemical company called Warsaw Chemical. We also have some guys from Black Diamond. They are assisting with, rolling this fund out. Christian Baldwin and Lane Auth, both from Black Diamond. And so welcome everybody and welcome to our attendees on just before this holiday. I'm sitting in for Will Mucker. My name is Joe Fulvio. And so Scott, what I'm going to ask you to do is let me drop this screen and let's put up your presentation and get the ball rolling.
Okay.
All right.
You hear me okay?
Yeah, we're good.
Okay.
All right. And I can see it, and you might put it into, slideshow mode just so it's bigger in case some of the guests, I can see it just fine, but some of the guests might want to have it bigger. There you go. All right.
So how would you like me to proceed? We can go through this a little bit at a time, and then you can just kind of give me some Q&A along the way where I can give some color. It would be,
Sure.
Is that okay?
Sure. Yeah, let's get there you are. And I was joking with the other guys. I don't know what you do with the 10 minutes a day that you have, nothing to do. I don't see golf or mountain climbing on there, but I'm sure you have avocations. Oh, by the way, I mentioned to everyone here that Scott and Sam were both guests on our podcast series. You may want to check it out and learn a little bit more about these guys and the company that they run. It's called The Road to Financial Freedom. You can get to it on our website, so definitely check it out. Go ahead, Scott.
Sure. Just in the way of background, so, and you're going to probably hear me talk a lot about this. As a matter of fact, we're in the middle of it today. Is we are the reason why it feels like, how do I have time to do all of that? And the reason is I have great people, and it's going to be a common theme that you hear about us today, and I think it's part of what sets Elpis apart. is we believe in the right people in the right seats. And so whether it's Elpis and the president of the fund is a guy named Sam Strausbaugh, which you'll see his slide in a minute. Sam's phenomenal. We got a phenomenal CFO. Same thing I have at my chemical company. I don't run the chemical company. I have a tremendous team there, and we use a system called entrepreneurial operating systems in all of our businesses, and it allows me to be more strategic. And so and be able to share what I know, whether it's at the chemical company or at our fund, which then invests in other businesses too, just to be able to do it in a systemized way. It's just, so I don't know if that helps kind of set the table a little bit about who I am and why it appears, how do I do all this stuff? It's because I've got great people.
Sure. Thanks. Thanks, Scott.
Mm-hmm.
You can go ahead.
Okay, so yeah, good. So a little bit back up on our fund, where we are today. So 75 million, that's a touch dated. We're at 88 million today. We started in 2016, and we are a company that, what we call a mini Berkshire Hathaway is kind of how is really the picture we want you to be thinking about. And we're doing it obviously in a much different way than Warren is today. He's a lot bigger than we are, but the philosophy is the same. And so we're looking for, companies we can put our money in that we think are going to generate above market returns and generate free cash flow. So, and then just some nuts and bolts that you see on this slide. We have, we're relatively small in the number of shareholders. We have like 76 shareholders today. We are audited by Clifton Larson Allen. We have a third-party administrator that does all our third-party reporting that, would generate an individual statement for shareholders or limited partners. We have 11 companies that we own already today, and we're going to talk a little bit about why that's unique in a minute. For a potential anybody else that's looking to invest in something like this is highly unique. The bulk of it today is in a company called Supernova, which is based in Chicago. And it's an unbelievable company, and we think it's super unique that shareholders or potential shareholders looking to invest could even be able to participate in a company like Supernova. But given it's such a big piece of what we're doing, we'll spend some time talking about it. And there's another bullet point on that. And I'm going to spend some time giving you more color on it because I think it's so relevant for you guys to understand what it is Supernova does. But let's look at the next slide if we want. Just to give you some more background on our history. So the fund originally was called Foundry, by a couple of guys that started it with me, but really were the principal owners. And then I ended up buying those guys out just so I could have full control over everything that was going on. Along the way, we invested in Supernova in 2016, and that was me that identified that because it's relative to my background. And I still sit on the board there today. And then you can see some other companies along the way that we have continued to invest in. And kind of where we sit today, what are we doing in 2024? And we could spend a little bit of time talking about what do we see going forward. So you want to look at the next slide? This kind of gives you, again, and I'm going to spend a little bit of time talking about why we're different, but this gives you how have we performed? And you can kind of see, and I don't know how many people would be familiar in private equity or venture, and we're happy to chat about that, but there is a thing called a J-curve relative to private equity, and J-curve to me is most funds take time to mature before they start to perform, and you'll see that even in our own numbers. So early on, we weren't anything exceptional yet, but you can start to see our numbers have started to really go. And you can see starting in 21, we had a big year. 22, relative to the S&P, we were, 20+% ahead of the S&P. We were positive. The market was down. 23, again, we were exceptional. We were up at net, I think 45% range in 23. And so, we have now consistently started to perform more than our goal, our target that we tell our shareholders is we want to be 10+% ahead of the S&P. Just to give you some feel for that. Let me just talk a little bit why we're unique, which is a little bit off topic, but just so that you can follow along. When you become a shareholder in Elpis, you're buying what we already own. Traditional private equity or venture, you would put money into a private equity fund or commit to put money into a private equity fund that is going to be based on a thesis of what they're going to go put their money in. So that's one differentiator. The second differentiator is most private equity and venture funds have a time mandate, meaning that if you put your money in, they would most people say we'd want it back in 5 to 7 years or some timeline like that. Well, I think that conflicts with investment philosophy, like I mentioned, it ties back to Berkshire. What does Warren do? And I tend to believe this in my own mind, and is when you find something good that is growing, why would you want to sell it? And I mean, and I live that in my chemical company. I have absolutely no reason to sell that business because it's growing fast, and there's no reason why I would want to sell that thing for for another 10 years minimum, until maybe Scott might not be around any longer. And then we might think about it. But the fund I look at the fund the exact same way. And in full transparency, the general partners, which include myself, we've got $15 million of our own money in here. So we put our money in with you, so that we're fully aligned. But I also don't like Supernova. I have absolutely no intention of selling that business anytime soon because it's growing incredibly rapid, and we don't want to sell until we think it's anywhere close to reaching its full potential. So I know that was a sidebar, but relative to kind of the slide, and let's go ahead and flip ahead so we can kind of give you more.
That is a good contrast, Scott. I'm glad you brought that up with a lot of what we see. This is predicated on you're buying into existing businesses that are producing revenue, and your acquisition of Foundry was you invested something in an industry that you knew. So yeah, that is a good differentiator.
Thank you. Hopefully that's helpful for people to understand. This gives you a little bit, I mean, this slide that's right in front of you now talks about what it is you're going to be buying. I mean, so these are the companies we own today. And just also, so we don't own all of the companies 100% ourselves. But for example, if you look at the manufacturing slide, we own about 19% of Diversified Wood, but we do own 100% of Pike Plastics Recycling, which is in Southern Ohio. At Supernova, we own 11+%, right in that range of Supernova, which doesn't sound like a lot, but the people that are partners with us are substantial, and there's a big family office in Chicago that's a shareholder in Supernova, and the gentleman running it has made a ton of money in his lifetime, and he's going nowhere. So just so you fully understand that piece, Case Pacer, we own a majority. Barrister, we own majority. Symphony, we're small. Purchasing Platform, we're a partner in there with a family office in Chicago. Think Health is small. Mesh is small. And the garage doors, right now we're in control of the ones we own. But eventually our plan is to be a minority partner in there and bring a much bigger firm to the party in the garage door roll up that we're working on. So And truck wash is kind of to be determined. We've done our homework on it, and when we're ready to play, depending on new shareholders, then we will start to lay the groundwork for our truck wash business. Okay, so distribution of the portfolio today is, again, going back to why we're different. So you can look at this and say, holy cow, Supernova is a big piece, because it is. And it's very valuable. So largely, I want you to spend some time understanding Supernova, and we'll spend a little bit more time on there. But this was a year old, and that's even more today. I mean, we're about 88 million today as we sit here. And Supernova, I think, is in the 53 or 54 million dollar value range, and then proportionally down from there on the rest of it, that we think ultimately the rest of them will start to catch up a little bit as far as dollar value. But they're kind of a lot of them are newer, and as I said, it takes a little while for a business to mature and stabilize before the value starts to increase.
Scott, one point of clarification, maybe
Sure.
just to make sure that everybody understands, is the value here is just the value of what you got, the percent that you guys own. So this isn't saying, right, 100% of that company's value is what you see here, just what's inside the portfolio.
Great clarification, Christian. So Supernova, to this slide, this is what Elpis owns in Supernova. The total enterprise value of Supernova is around 560 million today. Our portion of that on this slide was 47 million. Today it's around 50 million plus for us. So good clarification.
Good.
Again, I touched on a little bit of this, but these give you a little more specifics about, say, let's talk specifically about Pike. It's in Southern Ohio. We have a new CEO in there. Our EBITDA target is behind a little bit this year. We had a hiccup along the way, so we're not tracking. But I would say for next year that will be we'll hit those targets now that we're seeing stuff to calm down a little bit in there. That shows our ownership in there. The ownership, we own 100% of the common. The only other ownership in that company is management. So we like to make sure the management team have shares in the company. And then I would say that hold period of estimation right now, that's fair, unless but I would tell you, we always want to reserve the right. If the thing's still growing super fast, we might continue to hold it if we continue to like it. Diversified Wood is a Southern Indiana company. I would tell you that business, we are close to wanting to exit that one. And the business is, I think the management team is looking to buy us out, and we're more than fine with that because it's a small value to us and it doesn't really impact our total rate of return anymore. You want to go to the next? This business we started up so ICS. We started this one from scratch because of Purchasing Platform, which is on your right. Purchasing Platform, and so I'll come back to ICS in a minute, is a company in Chicago that it's a procurement software, which means, so if you, they're big companies that they're selling to today are either mobile home parks or multifamily apartment complexes. And so it helps them manage what they call their tail spend. So forgive me for the acronyms of what companies call their tech, but what that really means is if you own an apartment complex, you got to have tree trimmers, you've got to have, you're going to order stuff from Home Depot, etc. And so they manage that spend so that you're not wasting money going to Home Depot, or people that are managing parks all over the country. They tend to leave a lot of money on the table. They get no synergy from their spend. So that's what Purchasing Platform does. And again, we're a shareholder in there with management and a big family office in Chicago. And then Impacted Contracting Solutions, we started because there were nobody trimming trees for these mobile home parks. And so we thought, well, there's no reason. We see there's $10 million worth of tree trimming that they can't find people to do the work. So we decided we'd start a little business to do that. It cost us nothing to do it. And so we're kind of following purchasing platform around trimming trees. Case Pacer and Barrister. Case Pacer is in what I would close to being, is I always refer to these companies kind of my children, but Case Pacer is like a high school student. It's starting to do pretty well. The business is about, top line's going to hit 2.5 or 3 million this year. But we've got a right person, right seat running this business. And I think they've got a technology that can grow a ton. So enterprise value today for us is, 10 million range is what the business is worth. We think it's got a ton of upside. So that business is pretty exciting. Barrister, this one I would tell you, it's generating a nice cash flow. We're just trying to decide today, so cash flow to us is measured in a lot of ways. This one is measured off of EBITDA earnings before interest, taxes, and depreciation. So it's got a nice one. It's actually run about 1.3 million this year. What we're trying to figure out though, is it something that we think we can grow to 10 million EBITDA? And I would tell you our investment committee doesn't really think so. So most likely we'll probably look to exit that one and put our money in something else. And we've done well with it. And but we're always looking at where are we today and where do we think it's going? And if we think we can do better in something else, then we would cash our win in and move on. That's kind of how we're thinking about it. Mesh is another one that's doing great. We own a small piece in this one. I personally own some of this one. So this was really pre-Elpis. So that's why the position's so small. But I personally have, money in that company and the business is doing great. It's literally super close to what they call a letter of intent to sell. And it's going to exit for a nice number. So that one may not be around much longer. Symphony's growing like crazy. Again, we got in kind of late there and, that's a business that I wouldn't expect that we're going to own a whole lot of, and it's not a huge holding for us at Elpis right now. Think Health, also small. I won't even spend time on it because it was so small. It's hardly relative to talk about it. When we bought in, we really wanted to see, I will tell you a little bit about why. We put $250,000 in there just to give you a feel. Our goal is we really wanted to put like 3 million in if they hit some performance metrics. And they didn't hit their performance metrics. But given that we're in a convertible note, they're going to buy, get us back. So we're going to make a little bit of money on it and we're going to move on to something else. Supernova. Okay. So let's talk about Supernova because it's kind of the beast in our fund. The thing, let me walk you through what this slide says, and it looks like a lot of gibberish, so bear with me. So securities-based lending is what they do, and it's a financial technology company, which means everybody talks about it as FinTech. But what they do is enable a loan to be made on somebody's portfolio. Okay, so if you happen to have an account at Merrill Lynch or name a big firm, those are publicly traded securities that you would own at Fidelity, Schwab, etc. Those are securities, and a loan is placed on those securities. So that's what they call a securities-backed loan, or what they call an SBL, is how they shorten that. And we make the loan happen faster and quicker. The reason I knew about it is because I was in the wealth management space for years. And when you had a customer, let me walk you through the pain that Supernova has helped fix. If I worked in, let's say I had somebody had a $10 million account, which is a substantial account. They had 5 million in municipal bonds. They wanted to borrow against their portfolio for something else they wanted to do in life, but they didn't want to sell because they might only need it for 6 months or a year. I wanted just to set that up as a securities-backed loan. And so if I were doing that in my world, which I did some of it, you would end up doing 3 years of tax returns, and you'd have to go through underwriting. It takes 6 weeks to get a loan approved. Securities-backed loan under Supernova happens in 20 minutes. And so it is wildly successful because, so let's go back to a wealth management firm. So our customers at Supernova are wealth management firms, not just one advisor, but a firm, or banks. So Royal Bank of Canada with RBC was our first customer, just to give you a feel. That Royal Bank of Canada's securities-backed loan portfolio, when we started helping them as a customer, was 2020. And they had about $150 million worth of loans on their books at that time. The assets that the customers had at RBC and their wealth group were, call it 250 billion. So about 100 and call it 150 to 250. So very few loans relative to how many client assets that was, because it was cumbersome. Supernova, by making it easier, where they're at 6 billion today. And our success is tied to a bank's loan growth. So we're getting paid on every loan that we help facilitate. So let me expand that now into Schwab, Fidelity, Bank of New York, and 19 other banks are now customers of Supernova. So let me give you one last scenario. Why would we want to sell that business today? So our business is, say, $35 million in recurring revenue as we sit here today. We got 25 million in the bank in that company, no debt. And all of those, a whole bunch of those customers that I just mentioned to you have not even started to produce revenue in any meaningful way yet, because they just have hired us to fix their tech. Schwab is 15 trillion. Bank of New York is 36 trillion. Fidelity's 12 trillion. And then a lot of the other banks that we're working with. So we now are a market leader. We have absolutely no reason to sell this for some years to come, because it's going to scale like crazy. So let me pause and take a breath, because that's a whole lot of information.
It is. It's interesting. So you're saying that we have a lot of investors that maintain one foot in the alternative asset space and another with traditional securities. So if they have a portfolio, they can leverage that. What is the typical leverage? What do they do typically? With those loans?
Great question. I think there's all kinds of things people would use a securities-backed loan for. Whether it would be buy a condo, buy a vacation place, they might use it for a business need. You might, I mean, sources and use are all over the map. Some people would actually use it potentially to buy other publicly traded securities. But the big ones would be either personal use, and it may be, maybe they've got a kid, they want to get started in a home, could be all kinds of different uses for somebody setting up a securities-backed loan.
We have a question, if you want to take it, that's germane to exactly what we're talking about right now. And Tim has chimed in, and he says, does Supernova offer collateralized loans for existing mortgage notes?
Existing mortgage notes as in collateral, like in a CMO, like a collateralized mortgage obligation, publicly traded?
Well, I think he's referring to alternative assets that he holds. Mortgage notes is something I do. It looks like he's doing it. I think here we're referring to, and not to answer the question for you, Scott, to Tim, but we're referring to portfolios of listed securities.
Correct. Now, I will tell you, Tao has developed, so the CEO's name is Tao Huang. Tao built Morningstar and a number of other companies. He's an unbelievable operator of a company. So right person, right seat, clearly with this guy. And he owns a ton of the company too. But to tell you specifically, and I'd have to get back to you on that question, but he has built, and I probably shouldn't use customer names, but there's a huge Wall Street firm that he has built a tech, they're using our technology now on SpaceX. Okay, so SpaceX is not public yet. Okay, most people SpaceX because of Elon Musk, but they are the customer that hired us to build this technology is building it on 4 private securities also. And the reason is, if you stop to think about it, so SpaceX is, I don't know what the market cap will be for SpaceX, but it's going to be a big number, 100 billion.
Hmm.
If you are an executive at SpaceX, you might have a ton of net worth in SpaceX stock, but you have no cash. Okay, so if now via Supernova, those guys today can borrow against their shares, and be able to use their capital to maybe buy another house. I mean, you might have a huge net worth in SpaceX and have 0 cash.
Right.
And so what they're using it now for is helping this investment bank be able to go to their customers and say, we have a tool to facilitate a loan for you to be able to get access to some liquidity. And so, long-winded answer to the mortgage question, I would have to find out what specific mortgage, is, and is it something that we could lend on at this particular firm? So possibly, I just don't know without knowing more specifics.
Interesting. Yeah. Interesting. Because the mortgage notes are a direct claim on a specific piece of property. So it's well collateralized, unless Tim is doing second position or third position. So that's getting into the tall grass. Jim wants to know what the interest rate is on security-backed loans. What does it pay?
Great question. Okay, so make sure I'm answering the question relative to his question, but so if I'm a customer and I set up a securities-backed loan, the rate is set by the institution that's the bank. So Supernova is not the bank. We facilitate the loan. Okay. There's always a lending institution that is providing the capital to the customer.
Right.
Okay.
Side. Yep.
But what I can tell you is those rates tend to float off of, it used to be called LIBOR. I think it's SOFR now, is the big banking term. But every bank has rates that it's going to be specific to the financial institution that's making the loan. So, and it's also, I can tell you macroly on the size of the loan. So sometimes if you have a $50,000 loan, the rate's typically higher than a guy that might borrow $5 million. So the rate on a $5 million loan is a lot lower typically. So just to give you a feel, but they're going to be today, I would call it 6 or 7%, would be the market rate on an average loan for a customer of one of these institutions, just to give you a feel. Now, I want to also make sure you're not asking about what does Supernova make off of that. Well, we don't, since we're not the bank. What we get paid is either what they call a line fee, or we might get a recurring fee from the bank based on how many loans they have outstanding. And typically that runs about 11 basis points on all of the open lines. Okay. So the total book of business today that we have at Supernova might be 24 billion that we are servicing. But just so you kind of have a feel for where we think the business is going, I just told you we have a whole bunch of number of customers that are now online or ready to do loans with us, our technology. The other big thing are what everybody's aware of is interest rates. So if interest rates are at 9% on prime or 8.25%, 8.5%, whatever it is, there's a lot less people willing to borrow money when the loan is 8% plus at prime. But if rates go down, what might happen to that book of business? It might go up a lot. So we expect our loan book to go up tremendously as interest rates come down, which will drive obviously a ton of revenue growth.
Okay. All right. Well done. I hope that didn't interrupt your momentum, but I think those were excellent questions. Thanks to
Happy to do it.
Yeah.
Yeah, happy to do it.
And I have one I'll hold on to
Okay.
from Tim till the end, but go ahead, Scott.
All right. So So Christian and Lane were nice to help this. They helped us complete this slide for you all to kind of see. This is based on the ownership. You see that on the left hand of the slide there. This is what we own in each of these companies, as I had mentioned to you. You can see our revenue line, and then we're going to show you kind of EBITDA in a minute, but this is revenue by company based on the ownership of the piece that we own in each of these businesses. So as I mentioned, going back to the macro, we're different. We are not a traditional PE or venture firm. Right here is what we own. So you're buying things that we can quantify to you and show you what we own. And I think if you want to flip the next one, I think it goes into EBITDA. Yeah, there we go. And so you can kind of see what happened in 21. And obviously we were around prior to this, but this gives you a feel of where have we been and where do we think we're going? Okay. You can see the whole thing is starting to become what I call a mature kid that's just about ready to get out of college. Okay, so EBITDA in 23 was positive, 24 has grown a lot, and we think 25 is going to be substantial. The thing that you want to pay attention to is, let me just highlight one other thing on here. Supernova shows 10.6% ownership there. That's fully diluted after the equity for the management team, by the way. But you don't see a lot of EBITDA growth there. Okay. Well, the reason is Tao reinvests in more employees to be able to scale the business. But I will tell you, the business is still profitable. He's just trying not, I know this sounds crazy, trying not to make money because his goal is to drive that recurring revenue through the roof. Eventually it's going to make a ton of money because if anybody knows kind of gross margin in a business, the gross margin at Supernova is 92%. We make a lot of money, and eventually it's going to throw off a lot of dividends. But today it's still not, relative to its value, not throwing a lot of cash back at Elpis today. That makes sense?
Mm-hmm.
Okay, so now I'll leave that to you, Joe. What do you think we chat about from here?
Yeah, we've got a couple of questions. Tim, again, you had referenced Buffett at the beginning, and is this kind of the vision, that you're following in that path? And I think you did at the beginning of it, but Tim might have joined a little bit later, and maybe just recap the Buffett analogy that you had drawn at the beginning.
Yeah, so
I think, just, and then just to add on to that real quick before you answer that, Scott, Tim was pointing out that Buffett eventually took Berkshire Hathaway to the market, right, in terms of putting it out there. And is that part of your vision with Elpis, maybe to go, IPO at one point?
Mm-hmm.
Better stated. Thank you.
Yeah, great question, Christian. And so let me help you with that answer. So as you guys can see, based on that prior slide on EBITDA and cash flow coming back to the fund, well, how it relates to Berkshire is, as a shareholder, a potential shareholder, or how I actually view it for all of our existing shareholders, is if somebody wanted to redeem their share sometime, if we're generating free cash flow, what does Warren like to do? Warren likes to buy stock back. So it's accretive for the fund. So the bigger and stronger we get as this thing continues to get stronger and bigger, I'm a significant shareholder. If somebody wanted to tender shares as part of how we would deploy capital, part of how we would look at capital deployment is buying shares back. So that's number one. So as we are private, not public, to Christian's point today, we would, that's one form of way of getting liquidity to our shareholders. So that's number one. But to your point in the longer vision, Christian, if we are successful as we think we will be or already are, but we need more scale to be public, then we absolutely would look at that, because we could then provide liquidity to our shareholders daily You know, so that is absolutely part of our longer term vision. We just obviously need more scale before we would contemplate that. So we're in the early stages of going that way, but that's kind of how we're thinking about it.
Interesting, interesting. And then, you know, as you're progressing and identifying new businesses and standing up and dealing with the ones you already have, what's your acquisition process like? I mean, how do you pick viable prospects from what must be, you know, an enormous deal flow? You know, what do you look for? What gets your attention?
Yeah, great question. Well, our investment committee, we have a process that we believe is pretty sound. Is because if we look at our portfolio of what we've already walked through with you all, if we think our rate of return projected is 35-40%, let's in a normalized environment. I'm sorry, this is sidebar. We mark our portfolio to market. So you know, when you saw our number a couple of years back was 5.7%, that doesn't mean our portfolio didn't grow, but the market comparables were down. So even though we were growing, they were down. So we marked to market. And so, but if we looked in a normalized flat environment, we think our company should grow at 35 to 40%. So that creates a hurdle for us to look at anything new. It's got to be greater or better than that, or why would we put our money in? All right. So, you know, because it doesn't make any sense to diversify, bring new shareholders in when our existing shareholders would get diluted if we were buying something that was less than that. So we have to build a philosophy around an idea that we can support, that we think it makes it worth our time. Let me give you an example. We almost spent no time on it. We're looking at garage door roll-up right now, to be specific. So garage door servicing companies, those seem to be extremely boring, right? Why would we look at that? Well, so we're buying a business in Northwest Ohio right now that is $5 million top line business and makes about $600,000 profit. We can buy that business, or actually, yeah, we're closing next week for, you know, right at $2 million. So less than, or just a touch over 3 times earnings. Okay. So what would Warren Buffett say about that? You can buy a business for 3 times earnings and then figure out how can we make it worth more than 3? Okay. Well, what happens if we put 10 of those together? And now we have a portfolio of $50 million top line with a 10% EBITDA. Okay, that's $5 million. I can tell you, and we've already validated it before we started playing, what's that worth? That's what the market would call a platform play. So we've done the work of assembling this whole bunch of garage door companies around the Midwest. But we have a CEO who's going to run these businesses to drive synergistic cost savings. So also just think about it logically, is the little guy up in Ohio, how much leverage does he have on the manufacturers of motors and springs and doors if he's buying, I don't know, a couple $1 million a year on his 5 million in sales? Well, not a lot of purchasing power, but if you're at 50 million or 100, or what's that worth? So that business is worth a lot more as we assemble a bunch of small ones. So what does that look like on an IRR, or rate of return basis? So this is a long answer to your question, Joe, but if we don't think we can make 40, we're not going to look at it. So we could show you our analysis of how that garage door roll up makes sense for us to put more capital into that. Okay, does that help?
Very much. Yeah, just to get an idea of what attracts your attention. Once you're involved in it, I'm an old market researcher and got involved in a lot of different industries, and each industry had unique cost structures and expense ratios. What was considered a large expense in one business would be considered a very small expense in others. There's marketing, selling, competitive environment, regulatory environment, legal and liability. how do you guys get your arms around that and create the KPIs within those businesses that make sense and so you can track it and you understand you're making progress?
Yeah, great question. This goes back to some of my opening comments. You got to have the right person in the right seat. So
Mhm.
if you look at the people running our companies, Tao is, built an incredible amount of technology in his lifetime. As far as understanding, anybody ever heard of SOC 2 compliant technology software? Well, what does that mean? Well, it's a fancy word that says somebody can't hack your technology to get at somebody's money. Well, what does Scott know about SOC 2 compliant? Like nothing, all right, like zero. But Tao Huang knows how to build a SOC 2 compliant business, all right? So uh, what do I understand about hanging a garage door? I was zero. I don't know anything about that. So we want people that have been around these businesses to understand that. I mean, as the garage door business, I mean, so the gentleman running uh, the garage door roll-ups guy named by Mike Hyde. Mike Hyde is a very sophisticated manufacturing guy. He's already sold a business for quite a bit of money. He's been learning on the ground at a garage door company, learning the inefficiencies in the pricing and the inefficiencies in the technology, the inefficiency in their purchasing power. How do you make sure all the trucks look and feel the same? The safety. So that goes into those businesses that you need to follow. So we want somebody that's going to own that responsibility, that is vested in the business, because I can tell you, Scott, Sam, other people don't have time to oversee that, nor do we have the expertise to do that. So you need talented management teams. So we trust that to our executives that are running the company. And that doesn't mean we get the executive correct every time. That's the hardest part of what we do. But we are very driven to make sure that our CEOs, that we have ownership in businesses. Those are the guys that report to us. That's our job, is to make sure that we think they're delivering the right culture, delivering the right results, that they have a core competency in the business that they are running. And then we evaluate them. And we've had to make changes too along the way. So we're not perfect at that. And that's part of getting these children to mature. But when we get them right, we know they're right. I spend almost zero time supervising Supernova today. In 2016 to 2019, the CEO of Supernova was a different person. Tao joined in mid to late 19. And since Tao's been there, Scott does zero. I just get out of his way. I get out of his way. He's phenomenal. So I'm not sure that I answered that 1,000%, but
No, that's good. No, I appreciate that answer. And the reason it sort of bridges back to the title of this thing that, here we talk a lot about investing in what you know. In this case, you're bridging through, through Scott and his colleagues to investing in what someone else knows. So,
exactly.
Our people are used to having their hands on property and used to, direct ownership. Well, this is your bridge, and this is the guy that's just like you, who happens to be running the garage door business or is going to be running the truck car wash business.
Mhm.
So that's an interesting way to kind of tie everything together. Let's talk a bit about the fund itself. It's for accredited. The accredited process, is it a third-party validation? Do you need one of the three big companies that are involved in this, or do they submit that to your admin? Your admin clears it?
Yep, that's correct.
All right.
Yep, that's exactly right. We have, several, obviously a PPM and what they call limited partnership agreement.
Right.
Those are part of the onboarding process that somebody would like to see those and review those. And of course, we answer questions about that. As a shareholder, if this is kind of where your head goes next, Joe, what can you expect so our third party administrator, they're our record keeper and our communicator with our shareholders. So you will get a quarterly statement. Actually, it's online. You can see it every month. So on how we're doing based on a position, you can see what the companies that are valued based on the third-party valuations we use. So we actually just switched that. We used SEI for years. We actually just hired a firm, and I just left a meeting to come do this. A company called Venture 360 is now going to be doing it for us, and be saving a ton of money, by the way. They're actually super talented and they're cheaper. But they will be the communication for us today and going forward for our shareholders. So you can see how we're doing. So that's just part of the mechanics of being a shareholder with us.
That's great. I want to talk to you about that offline, because a lot of the people who are providing investment opportunities are going with one platform or another, and our challenge is to integrate with their onboarding process. So you probably get a call from me about that.
Happy to
What's,
happen.
what's the minimum?
250,000 is our minimum.
Okay. And the hold, I think you did cover this. The hold is 5 years?
Yeah, I mean, the hold is 5 years is the way the documents will read, and there is a small, I think we charge a 3% early request for the redeeming before that period of time. We've tried to honor that. We view shareholders extremely important. And so if somebody needed it before then, but there is a early redemption fee of 3%. If you were to say, I need to tender this for some reason prior to.
Okay. And then frequency of distributions, when do they occur? How does that work?
Great question. So we have changed our philosophy a little bit to really align with how Warren does it. I mean, so we sold a concrete company. I don't even remember what year it was, but we made some money on that, made like $4 million. We had about 4 million in it, sold it for 8. And we paid a big dividend that, or we allowed people to take 100% or take 50% or roll the whole thing. But what we decided is people were paying us for a total rate of return, and what we would prefer to do now is take all the free cash flow, driving enterprise value higher. And if somebody would like to tender shares, we'd rather buy your shares back at a higher price.
Okay.
Ideally, just looking at it from my seat, what we hope to, as people get to know us and get more comfortable with us, I view partners truly as long-term shareholders. And if we show you that, where else are you going to kind of get consistent rates of return higher than the market? Obviously we got to earn that from you, but I mean, I look at it no different than my own shares in there. Why would I sell them? It's it's the little old lady that bought Berkshire in 1975. She's got a ton now. And so, but we need to earn that part. So
Okay. Okay. So there'll be, upon exits, there might be,
cash comes back.
Cash distributions and things
Right.
like that. But that's, I think, all right, there's no more questions. Getting to the top of the hour, the slide that you're looking at right now is how to get a hold of the guys that you've been listening to today. I want to thank Scott Wolfrum for coming over and getting into the tall grass with us on this, and then Christian Baldwin and Lane Auth from Black Diamond. Guys, we always appreciate the content you provide to our audience, and our audience, we always appreciate you showing up. You'll get, anyone who registered will get a replay link. I'll send a replay link to the guys as well. And then good luck with everything. And thanks again for being here, everyone.
Yeah, thank you. We appreciate the opportunity.
You're welcome. You guys take care. Have a great day, and have a great Labor Day holiday.
Thank you.
Bye-bye.
Thank you.